Welcome back to Investing Talk podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it. I think the big story here, the fundamental case, is that Rocket Lab is really making this huge shift, right?
That's it, exactly.
Yeah.
They're moving from being, just a niche, small launch player to becoming this scaled, diversified space infrastructure company.
A one-stop shop, basically.
Pretty much. They want to build it, launch it, operate it. And the latest financial results, that's the first real proof that this whole strategy is actually working.
Okay, let's dig into that proof then. Let's talk numbers, because Q3 2025 revenue was what? A record $155 million?
A record. And that's a 48% jump from the year before. That's massive growth.
And it's not just a one-off spike either. The guidance for Q4 is even stronger, pointing to something like 170 to 180 million. That's not just growth, that's acceleration.
Right. And that top-line growth is so important, but what's really fascinating to me is what it's doing to their efficiency.
You mean the margins?
Yeah, the margins.
Yeah.
As they scale up, their costs just aren't keeping pace, which is, the textbook definition of operating leverage finally kicking in. We saw GAAP gross margins hit 37% in Q3.
Which was a record.
A record, yeah. And they're guiding for up to 39% in Q4. That's a huge deal.
Okay, so explain that for us. When you see a jump like that, from 37 to 39%, for a company that builds rockets, why is that so critical?
It's the whole ball game. It shows that the business is fundamentally getting healthier.
Yeah.
Every single new dollar of revenue they bring in costs them less to produce than the one before it.
So all their fixed costs, the launch pads, the factories, the engineers, they're spreading those costs out over way more revenue.
You got it. When margins expand that quickly, it's a huge green flag.
Yeah.
It just makes that path actually being profitable so much clearer.
And they've got the cash to walk that path.
Yeah.
They have over $1 billion in liquidity. That buys a lot of security.
It does. It gives them a huge runway for R&D. But honestly, even more important than the cash they have is the demand they can prove, the backlog.
Right. The backlog is massive.
Right.
$1.1 billion. That's all locked in future work.
Exactly. And the best part is how quickly that's turning into actual revenue. Management thinks over half of that, so maybe 550 to 600 million, will hit the books in the next 12 months.
That is some serious forward visibility.
It really is.
But okay, let's talk about the elephant in the room. They're still burning cash to fund all this growth.
Of course. And the market is watching that balance very, very closely. The net loss was about 190 million over the last 4 quarters. They are investing heavily.
So how are they balancing that?
Well, the losses are narrowing, and fast. In Q3, the EPS loss was only 3 cents. The consensus on the street was for like a 10-cent loss.
Wow, so a huge beat.
A huge beat. And that tells you that the improving margins are actually speeding up the timeline to break even while they're spending all this money on their next-gen rocket.
Which brings us to their competitive moat. This is what I think really separates them. The vertical integration. They don't just launch stuff, they build it.
And that's where the real long-term value is. The space systems segment. Everyone knows them for the Electron rocket, but space systems is now the strategic heart of the company.
And that's everything from, satellite components to solar panels, even the whole satellite body itself.
All of it. The entire spacecraft bus.
So why is that so powerful? Why not just, buy parts from other people like everyone else does?
It comes down to 2 things: control and margins. By building it all in-house, they can guarantee the quality, the reliability. When your customer is the Department of Defense, they demand perfection.
Right. You can't have a supplier issue when a national security satellite is on the line.
Exactly. And second, the margins are just fantastic. Some of their component lines, like reaction wheels, they're running at 60 or even 70% gross margins. That is just manufacturing gold.
And we've seen them get real validation for that expertise, too. They just got that R&D grant from the Canadian Space Agency.
Yeah, nearly $1 million Canadian dollars. That's a really important win.
And that's to build a new kind of reaction wheel, right, for bigger satellites?
Correct. For satellites in that 500 to 1,000 kilogram class, winning a contract like that, it's not about the money. It validates their tech, and it locks them into these key government supply chains for the long haul.
And of course, none of this would work without the foundation it's all built on, which is the sheer reliability of the Electron rocket. That thing is a workhorse.
Absolutely. 19 launches in 2025.
Yeah.
That's a new record for them. Huh. But more importantly, a 100% success rate on recent missions for huge customers like JXA in Japan and KAIST in South Korea.
In this business, that's everything, isn't it?
It is everything.
Yeah.
Reliability is the ultimate product.
Okay, so if Electron and Space Systems are the engine of the company today, let's talk about the future. Neutron. This is their next generation rocket and where all the big money is going.
Neutron is the game changer. It's designed to be a medium-lift, fully reusable rocket. It puts them right in the sweet spot for, defense launches and especially these huge EO mega constellations.
Right. Define that for us. What exactly is the EO mega constellation market?
So it refers to this massive push to launch thousands of small interconnected satellites into low Earth orbit. Think global internet from space, Earth observation, that kind of thing.
And they need a specific kind of rocket for that.
Exactly. They need reliable, frequent launches that are bigger than what Electron can handle, but maybe not big enough to need the really giant rockets. Neutron is sized perfectly for that market.
And a big part of the story here is de-risking the tech. They just qualified that unique fairing, the Hungry Hippo. I love that name.
It's a great name, and it's a brilliant piece of engineering. They just shipped it to the launch site in Virginia, which is a huge milestone.
So why is it so unique?
Well, most rockets drop their fairing, the nose cone,
Yeah.
and then try to catch it or fish it out of the ocean. The Hungry Hippo fairing stays attached to the first stage.
It never comes off.
Never. It just opens up like a giant mouth, deploys the satellite, and closes again. It eliminates this whole complex, risky recovery step, which means they can get the booster ready for its next flight way faster and cheaper. It's fundamental to the business case.
But all that innovation costs money. Neutron is still a huge financial drag. R&D spending is climbing toward, what, $360 million?
That's right. And that spend is basically the reason they have negative free cash flow.
Now, management keeps saying they're at or near peak spending. In an industry famous for delays and cost overruns, why should we believe them?
That's a fair question, and it's why the market is watching so closely. I think their credibility really rests on the fact that they delivered with Electron. They turned that program into a reliable machine.
So they have a track record.
They do. And when they say peak spending, it implies they're moving from unpredictable design work to more predictable, standardized production. If they hit that first orbital launch target in Q1 2026, it will prove the whole spending cycle was worth it.
Okay, that makes sense. But let's flip the script. We have to talk about the risks here. Number one has to be Neutron delays.
Absolutely. The whole valuation is basically priced for Neutron's success. Any big schedule slip will push out profitability, and the stock will get hit hard. That execution risk is real.
And then there's capital risk. Yes, they have $1 billion in cash, but they are still unprofitable. The stock trades at a high multiple, which makes it super sensitive to any kind of market downturn, a risk-off period.
For sure. And we have to talk about the insider selling. You've got the CEO and a director selling, what, almost $275 million worth of stock in the last 90 days.
That's a number that gets your attention. Now, the argument is always diversification after a huge rally, but it still creates some negative sentiment.
It does. But you have to put it in context. While that's happening, institutional ownership is still incredibly high, around 71 or 72%.
So the big money is staying in.
They're not just staying in, they're actively accumulating. We're seeing major funds initiate or add to their positions. So it seems like they see the risks as manageable compared to the long-term prize.
Okay, let's shift to the technical picture. The stock has had a monster run, up over 100% year to date. It's in a classic, strong uptrend, trading above all the key moving averages.
Very bullish configuration.
Yeah.
But you have to note the volatility. We saw that 10% drop right after a successful launch for JXA.
A classic sell the news event.
Exactly. It shows the stock is twitchy and prone to profit-taking, even on good news. But analysts tend to see those as, constructive pullbacks. They see it as a chance to get in near support levels if you miss the big run-up.
So looking ahead, what are the key catalysts for you over the next 3 months?
Okay, number one is the Q4 earnings report in early February. The market needs to see them hit that 170 to 180 million revenue guide and show continued margin expansion. No excuses there.
Got it. What else?
Number two is just the launch cadence. There are new missions for JXA and the ESA scheduled for early next year. They just have to keep flying successfully, keep that operational momentum going.
And I assume number three is Neutron.
You know it. We need updates on Neutron milestones, engine testing, stage integration, getting that new launch pad in Virginia ready. We need to see physical progress to believe that Q1 2026 launch date is real.
So to sum it all up, it's a compelling story. You have real operating leverage, a huge backlog giving you visibility, and critical government contracts. It feels like they're moving out of that riskiest development
I
phase.
think so. And here's a final thought to chew on. Neutron gets all the headlines, but what if the real story is space systems? If that segment keeps expanding its margins up towards 50%, is it possible we should see Rocket Lab as a high-margin space manufacturing company that just happens to own its own delivery service?
That is a really interesting way to frame it. It completely changes how you think about the valuation. Well, that's all the time we have. Make sure to subscribe so you don't miss our next analysis.